The paper price just tried to bury silver again, not with a headline, not with a warning, with a quiet little trick. Push the quote down, shake the crowd, and pretend the whole move was a fever dream. But then one report hit the tape, and it blew a hole in that story. A North American silver giant just printed a quarter so fat it looks fake on purpose. $555 million in revenue, a margin that belongs in Silicon Valley, and $189 million in free cash flow in 90 days. That's what happened. The silver is weak narrative just got caught with its hand in the cookie jar. Facts first. The company's latest quarter showed record profitability, record cash generation, and a balance sheet that is healing faster than Wall Street expected. That's the hard data. Interpretation. If a real producer can generate this much cash while the paper market keeps acting like silver belongs at $20, then something is broken. Either the miners are hallucinating or the paper price is lying. This is educational. We manage risk. Here's the part that should make your stomach tighten. The stock still swings like a penny name. One slightly messy line item, one miss that barely matters, and algorithms slap the price down in a single session. That whiplash is not random. It's the same playbook we've seen before every commodity repricing. Shake, scare, scoop. So we treat this like adults. We follow the money. We separate the metal from the paperwork. We use this one quarter as a flashlight on the real silver market. Start in Nevada. Because the biggest clue isn't a quote on your screen. It's a mine that just crossed the finish line. The Rochester expansion wasn't a nice to have. It was survival. It was a $730 million bet that almost crushed the balance sheet. Leverage pushed past 7 times at the worst moment, and analysts sniffed blood like sharks. The question wasn't, will they grow? And the question was, do they make it to the other side? They did. Commercial production hit at the end of March 2024. By mid-2025, the plant reached its design pace, roughly 88,000 tons per day. 88,000 tons. Every day. That's a mountain of rock moving through a machine that turns geology into cash. And embedded in that rock is the thing the world keeps pretending is optional. Silver. Not silver the shiny, silver the wiring, silver the contact, silver the conductor, silver. The material that quietly sits inside the systems we're building to run the next economy. This timing is brutal for the shorts, because while that expansion was ramping, silver stopped behaving like a sleepy commodity. It moved, it climbed, it got loud. And every dollar higher isn't just a line on a chart. For a producer with largely fixed operating costs, it's gasoline poured on profit. This is operating leverage, and it's brutal. And when your trucks are already running, your pads are already built, your crews are already paid, a higher silver price doesn't double profit. It bends profit like a spring and then snaps it upward. That snap is visible in the quarter. Adjusted EBITDA margin hit 54%. That's not a typo. More than half of every revenue dollar became operating earnings before interest and taxes. A miner printing software margins should set off alarms in your head because it means one thing. The product is scarce and the buyer doesn't have a substitute. And here's the trap most people fall into. They see those margins and they assume it's just a good quarter. They assume it fades. They assume costs will surge and crush it. Possible, but watch the structure. Rochester is now at scale. Scale is what turns a mining business from fragile to formidable. It spreads fixed costs. It stabilizes output. It gives management room to optimize, not just survive. Now watch the second clue. The company didn't stop at volume. It went for grade. The acquisition of Silvercrest and the Las Chispas mine matters for one reason. It changes the business model from one big engine to 2 engines tuned differently. Rochester is a volume machine. Las Chispas is a margin machine. One chews through a massive amount of lower grade material. The other bites into smaller amounts of very rich rock and spits out high value ounces with insane economics. Fact. Combining a scale asset with a high grade asset diversifies cash flow. Interpretation. That's how you build a platform that can survive volatility and still win the upside if silver runs. And you can feel the strategic intent in the map. One asset in Nevada, one in Mexico, not a portfolio scattered across unstable regimes where governments wake up and decide your mine is now public property. Not a supply chain that collapses because a minister wants a bigger cut. We don't need perfection. We need probability. And jurisdiction is probability. Now here's the thing the paper market doesn't like. This setup makes the company harder to break. In 2023, debt made it fragile. In 2025, cash flow is making it dangerous. Let's talk balance sheet because this is where the story turns from interesting to inevitable. In the worst stretch, debt loomed over the whole trade. Net leverage above 7 times is the kind of number that makes bankers sharpen knives. One sustained downdraft in silver and you're not investing, you're praying. Fast forward. Debt fell from above $600 million to roughly $370 million. Nearly $230 million cut down without some desperate dilution event, not by selling stock into weakness, by producing metal and converting it into cash. That matters because it changes who controls the narrative. When a miner is drowning in debt, the market dictates terms. When a miner is throwing off free cash flow, the miner starts dictating terms. And this quarter didn't just look good. It showed a machine with momentum, $189 million in free cash flow in a single quarter. That is the kind of number that turns pay the interest into pay the debt down fast, then choose what's next. Here's the open loop we need to keep in our head. What happens to valuation when net leverage drops below 1? 5 times and the market can't call this a distressed story anymore? Because that re-rating doesn't come gently. It comes like a door slamming. Now, about that volatility. Why does the stock still get whacked on small misses if the business is printing? Because the market isn't a referee. It's a casino. A tiny earnings miss can be real. It can also be theater. A rounding error dressed up as a reason to sell. And when enough forced sellers hit at once, ETFs, quants, momentum funds, the move feeds itself. So we ask the only question that matters: is the business deteriorating, or is the tape trying to make you feel something? Fact: the company generated record revenue in cash. Interpretation: if price drops on tiny noise, that's not information, that's psychology. And psychology is the weapon the paper market uses when it can't win on fundamentals. Now zoom out, because this isn't just one company having a great quarter. This quarter is a symptom of a silver market that is changing character. For decades, silver lived in gold's shadow. Gold's little brother, the poor man's metal. Cute story, wrong era. Solar murdered that narrative. Right now, solar demand is pushing toward hundreds of millions of ounces per year. Put it against global mine supply, around 800 million ounces, and you can see the pressure with your eyes. Solar isn't a niche anymore. It's a monster with a feeding habit. And the industry is shifting to cell designs that can use more silver per panel. Efficiency goes up, great, but the bill of materials gets more silver heavy, and suddenly your green future is chained to a white metal the market still treats like an afterthought. Physics doesn't negotiate. Now layer on data centers. Every AI revolution headline is really a power and hardware headline. Servers, racks, connectors, high-performance chips, heat management, low-resistance pathways. Silver isn't the only material in there, but it's one of the few that keeps showing up where performance matters and substitutions fail. If we're wrong, where will it show first? Watch the build-out pace. Watch the demand for high-end components. Watch the grid upgrades. If that wave stalls hard, demand softens. If it keeps accelerating, the squeeze tightens. And then there's the biggest silent consumer, electrification. EVs, charging infrastructure, high-voltage systems, industrial motors, smart grids. These systems are basically giant permission slips for conductivity. Copper does a lot. Silver does the last crucial part where contact reliability and loss matter. So here's the contradiction that should bother you. We're told silver is just a speculative trade. But the world is building systems that require it like oxygen. So why does the paper price act like demand is optional? Because paper can multiply supply with keystrokes. Let's expose that. The spot price you see is set mostly by futures contracts, promises, IOUs, paper claims that get rolled and netted and settled without metal moving. It's a spreadsheet market wearing a metal costume. That structure works fine until physical buyers stop playing along. Try buying physical at the quoted spot. You can't. Premiums stay elevated, delivery times stretch, bars disappear, mints lag, dealers ration. That divergence is not temporary inconvenience. It's the market screaming that the paper quote is a suggestion, not a clearing price. Fact: physical premiums exist. Interpretation: the paper price is under stress because the real world is pulling metal faster than paper can fake it. And the stress shows up in one place first: procurement. Industrial buyers don't tweet. They don't argue on TV. They sign contracts. They prepay. They lock supply. They build relationships with miners and refiners, and they secure allocation like their factories depend on it, because they do. That's the backdrop to this quarter. The company isn't just selling into a nice market. It's selling into a market that is quietly rationing. Now there's a second open loop. If the physical market tightens further, does the paper market keep control? Or does the paper market get forced to follow? That's where squeezes are born. Now we have to be honest. There are other miners. There's competition. Some have higher grades. Some have more ounces. Some have bigger marketing departments. So why should we care about this one? Because it sits in a sweet spot. Scale plus grade plus improving balance sheet plus relatively sane jurisdictions. That combination is rare. A high-grade underground producer can print insane margins. but it may not scale fast. A giant global producer can scale, but it may carry political risk. A leveraged name can torque upside, but it can also implode if the cycle hiccups. This one is starting to look like a platform, not a lottery ticket. And that matters if we're entering a multi-year repricing. Now watch what the big banks say. They don't come out and scream silver to the moon. They speak in code, selectively bullish. That phrase is a tell. It means they want exposure, but only to names that can execute. It means the easy money phase, buy any miner, hope, might be ending. It means operational skill is becoming the filter. And it also means they don't want retail rushing in ahead of them and bidding everything up before they're positioned. So we read behavior, not slogans. When a company is paying down debt fast, buying high-quality ounces, and expanding capacity into a tightening physical market, that's behavior. Now let's ask the hardest question. If revenue is up, why does the stock still feel fragile? Because the market is pricing two realities at once. Reality 1, a producer printing record cash. Reality 2, fear that silver is about to crash because paper says so. That's the wedge. That's the opportunity. That's also the danger if we don't manage size and time. So we frame scenarios, not fantasies. Base case, silver chops in a high range, $60, $70 type zone. In that world, cash keeps flowing, debt keeps falling, and the market slowly accepts the new balance sheet. A dividend becomes possible. Buybacks become possible. Valuation creeps upward. Upside case, physical tightness escalates. Futures curve flips. Backwardation appears. Short positions get stressed. Premiums stay hot. Silver pushes through $80 and the psychology changes from trade to shortage. In that world, margins can expand again. Free cash flow can spike. Debt can vanish faster than anyone expects. And the stock can re-rate violently because the market stops valuing it like a cyclical struggler and starts valuing it like a strategic supplier. Now, watch this. The real trigger probably isn't a price print. It's a delivery problem. The first time a major industrial buyer can't source enough metal at a posted price, the whole narrative flips. Not because of us, because factories don't run on opinions. So here's your retention beat. What would you rather be holding when that happens? A paper promise or a company that pulls ounces out of the ground? Now we talk risk, but without the fake confidence. Risk 1, a global slowdown. If manufacturing contracts and projects get delayed, demand can soften. That can smack price in the short run. But we need to be precise. A recession can slow the slope. It doesn't erase electrification. It doesn't erase grid upgrades. It doesn't erase sovereign energy policy. Those are decade trends. A slowdown is a speed bump, not a cliff. Risk 2, supply response. Higher prices attract marginal supply and more recycling. But mining is not instant. Permits take years. Builds take years. Ramps take years. Recycling depends on collection systems and economics, and silver is scattered like dust across products. It's not sitting in neat piles waiting to be melted. Risk 3, substitution. Engineers always try to thrift. If silver gets too expensive, they search for alternatives, possible over the long run. But near term, the infrastructure is already designed around silver. Changing that isn't a software update. It's a redesign of manufacturing. Qualification, reliability, safety, that takes time. So yes, risks exist. We don't ignore them. We size around them. Now we come back to the quarter because the quarter is the anchor. $555 million in revenue, 54% adjusted EBITDA margin, $189 million free cash flow. Those aren't vibes. Those are receipts. And yet the market still offers dips on misses. That's what makes this moment strange. It feels like the tape is trying to convince you a cash machine is fragile. Here's the mistake most people make. They confuse volatility with weakness. In a commodity transition, volatility is often the sound the old narrative makes as it breaks. If you've watched other squeezes, uranium, palladium, natural gas, you know the pattern. Early on, the price fights, then the physical market tightens, then producers start printing, then the public notices, then the price gaps. We are not at the everyone notices phase yet, which means the best and worst part is happening now. Boredom mixed with fear. They want you tired. They want you impatient. They want you to sell your position because you can't take it anymore. That's the psychological war. So we do the boring, effective thing. We track the real signals. Track debt reduction, track free cash flow, track realized prices, track production volumes, track physical premiums, track delivery times, track the futures curve, track whether miners start getting approached for offtake deals that look unusually aggressive. Because if the squeeze is real, it won't announce itself with fireworks. It will leak through procurement behavior and inventory stress. Now let's bring you into it. What do you think breaks first? The paper price or the paper promise? If you had to bet on one pressure point, is it solar demand, data center build-out, or industrial electrification that forces the market's hand? Drop your answer in the comments. We want to see where our community thinks the fuse is burning fastest. If you want more deep dives like this, fast, direct, no fluff, hit subscribe. Short and simple. Subscribe so you don't miss the moment the paper game cracks. One more thing before we leave this quarter. When a miner turns into a cash generator, it gains options. It can buy assets. It can retire debt. It can return capital. It can negotiate better terms with buyers. It can invest in expansion while weaker competitors are begging for funding. Options are power, and power is what the silver market is shifting toward right now, away from paper traders and toward physical producers and industrial consumers. So watch the next set of moves. Does management keep paying down debt at speed? Do they accelerate buybacks? Do they do another acquisition to lock in high-grade ounces? Do they sign long-term contracts at prices that hint the real market is higher than the quote? Those choices will tell us whether this quarter was a peak or just the opening scene. Because the biggest lie in commodities is that a chart is the truth. The truth is cash flow. The truth is inventory. The truth is who can still get delivery when everyone else is told to wait. And right now, the numbers say the metal is tighter than the paper market wants you to believe. The squeeze doesn't start when Twitter screams. It starts when supply chains whisper, and those whispers are getting louder. Next quarter is the tell. If cash stays this loud, the paper story dies.